Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How is it going with you?
It's going great. We hope it's going great for everybody else as well. If you are watching us on YouTube, hit that subscribe button. If you're listening on the podcast side of things, hit that subscribe button as well. All the support means everything to Geoff and myself. Having a lot of fun doing it. In today's podcast, we are going to be going over part 2 of our Q&A series. We uploaded one last week, and then we have more questions. We want to keep it short and concise. Okay. So we're trying to keep each podcast to right around 25 minutes.
And we're incapable of answering all the Twitter questions in 25 minutes.
Yes. So we are...
Maybe because we have a lot of questions, or maybe because it takes too long to answer each one. You can be the judge of that in this episode.
No, it's a good thing. As we said in the last episode, I don't have my glasses, and neither does Geoff. So we're both kind of blind doing this. So I'm going to do my best to read. Everything looks a little bit blurry. But if you are watching us on YouTube, of course, you could see the question. So the first question says...
Follow at Focus Compound to ask questions.
That's right, for future Q&As. And we try to do one pretty much once a week because we want to, connect with the viewers and answer any questions that are on their minds.
Yeah, but we won't be able to get to everyone in the future because they start to get too long.
Yeah. It says, in your view, will current interest rate environment and/or Corona help or hurt the consolidation trend in small banks? Why/why not?
It might help. It might help. Yeah.
Why?
Just because very small banks earn poorer returns given the same earning assets as other banks could earn with those assets. So in general, if you have problems where you actually get to the point where you're close to making no earnings, you would be more willing to sell out. So yeah, that would help. I also think it'll do the same thing in the car dealer industry, but
Okay. CapEx versus DNA. Is maintenance CapEx really mostly DNA, or are the depreciation schedules kind to companies and the average CapEx percentage of sales or gross PP&E the more accurate number going forward?
It depends on the company. You can figure it out. It really depends on the company. Things like CapEx for sales makes a lot of sense at some sort of manufacturing company or something, but it can also make no sense at a company that's like operating a large site that brings in a certain number of people and stuff like that. So it really depends. Like the CapEx as a percent of sales is not something that's important for Disney or something. It can be something that's important at like a retail thing or whatever. But even then, I don't know. Remember, for most companies, DNA and actual CapEx aren't that far apart in terms of maintenance CapEx. We kind of exaggerate that. We look at the special circumstances with that, but depreciation is usually a pretty much is completely an expense that you have.
Best way to try and figure out if a company has pricing power over suppliers and customers?
So there's kind of two ways, I guess. One is mathematical and based on the past results. So if there's a huge decline in their unit volume, they will increase their prices. And I've seen several companies do that. That is the biggest tip-off. So I've mentioned the lime industry before or something. You don't see big price decreases despite the fact you have big decreases in the quantity demanded at the time of the financial crisis. And likewise, you take something like George Risk. George Risk actually increased prices after there was a huge drop off in demand for their products with housing markets. So they basically wanted to hit a certain gross margin. So say they wanted a 50% gross margin, they were okay with that. And then when there was a huge drop in terms of their sales, then the overhead cost absorption would be greater. So they'd have to raise the prices to achieve the same gross margin. The problem with both of those cases is you wouldn't know till after the fact. So there's no way to know ahead of time. The way you know is through scuttlebutt and stuff. You ask people. So like we've mentioned Breeze Eastern before or something, they could raise prices. And then I think TransDigm bought them and others and probably did raise prices. So they probably did the same sort of scuttlebutt that we did. You can ask people. You can just say what would happen if they raise prices on you by a certain amount or whatever. And if they say I would have to pay that, there's nothing much I can do about it, then there's your answer.
Next question, Michael Boston claims sales growth is generally more luck-oriented, while operating margins and gross profitability, gross margin time, asset turnover, are more skill-oriented for companies and managers. Would you agree?
Yes. I would agree. I would say that's, although it's very, I'd say organizations have very little control over their level of sales generally.
Next question. What has your experience led you to believe what generally are the best predictors of future returns of a company going forward? Starting valuation, consistency, growth, low asset intensity? Thanks.
Low asset intensity is very important.
Starting valuation.
And
Can I say all of those?
Yeah, starting valuation is very important too. I also should point out there are very few industries where like the person involved really matters a huge amount, but then not in others. So it depends. Honestly, there are people where like if they said they were leaving a bank to start up their own bank or leaving an insurer to start up their own insurer or something, I would be happy to bet with them without knowing anything else about the business because they're so operator dependent. But then in the same thing, if someone said I'm leaving from one manufacturer to another or whatever, I wouldn't do that. I'm leaving to start up someone I thought was great at some food brand said I'm leaving to start another food brand, that wouldn't matter to me. But like banking and insurance are ones where it's really important. And so sometimes it's the people involved and stuff. But yeah, the ones that they said there, I would say starting valuation and low asset intensity are two really, really important ones. And then if you have low asset intensity, the belief in growth over time matters, but only if you have low asset intensity. Otherwise, it wouldn't matter. But low asset intensity combined with industry growth would be amazing.
Next question. Can you talk about CapEx for fresh projects and companies and how you integrate them into your valuations? Basically, how do you take them into consideration with your valuation process, especially companies that are mid CapEx? Thanks.
Yeah. I mean, I just do my best to make a business judgment about it, whether I think it's good or bad CapEx. Same thing with an acquisition. If I like the acquisition stuff, then it makes me like the stock more. If I don't like it, then I will not do it that way. It completely depends on a judgment about whether I like or don't like what they're doing. I have no other basis on which to evaluate it. And I can be as wrong as management can be before. I mentioned that both, a couple companies we own, but I'll give the example of NACCO and stuff. NACCO once did a CapEx thing, an acquisition thing that didn't turn out that well. But at the time, looking at what they knew and what could have happened and stuff, it kind of seemed okay to me. So, and that's true with another company that we've owned too. So, it's not always the results that they get that matter. So I can be as wrong as they can. But if it looked like it made sense, then I would think of it as like a completely new investment, value it on its own, not as like a requirement that has to keep doing this CapEx. For a report where we wrote that up, there's one MSC Industrial Direct where we talked about the fact that they expanded like their distribution center and stuff. Once you do that, your earnings dip immediately, and then it takes a while for you to get back up because you aren't utilizing the whole place. So it can be that example, like they, it kind of hurt their earnings for probably 3 years or something was our guess of what would happen.
What margin of safety do you use for microcaps and small caps respectively?
Oh, we don't use anything that's different for them than big stocks.
Which is what?
Ben Graham had a policy not to pay more than 2/3 of what he thought a stock was worth in his appraisal method. And we take basically the same approach. If you see us paying 10 times earnings for something, it usually means we think it's worth at least 15.
Mm-hmm. Owned versus lease real estate. Thinking of the AutoZone model.
Yeah. Leased real estate gives you higher returns over time generally, and owned gives you more safety and stuff. We own a company in the UK that owns a large proportion of its real estate when many of its competitors lease the land. And that was part of the factor of why we bought them.
And he says factoring in exchange rates for international equities.
Yeah, I like to buy stocks where I think that the currency is undervalued on a purchasing power parity basis, and to avoid those where I think the reverse. So one of the reasons, not a huge reason, but one reason why we invested in a UK car dealer. One, they were a lot cheaper, UK car dealers than US car dealers. Two, I thought the pound was a lot cheaper versus the dollar in terms of purchasing power parity when we bought into it. And you can look up things online probably that can calculate purchasing power parity for you.
Next question. What would it take for Geoff to turn bullish, or at least not bearish?
A decline in prices. I mean, for a specific stock, lots of things can change, but for an economy or something, no.
Yeah.
No, it doesn't really matter. What matters in the long run for stocks is what the starting price was. Mm-hmm. So, I mean, that's just all that it is. So you have to have a change in pricing of the assets that you're buying. That's really it.
Next question. Warren Buffett likes to find things under 10 times pre-tax earnings. Do you use that to find things? Second question. The market cap on one end seems to be very expensive. Growth stocks while value is cheap. Thoughts?
I think the 10 times pre-tax earnings thing was based on an earlier corporate tax rate probably. So that could change a little bit. You could probably pay 13 times pre-tax profits and be at the same sort of level as what, if you're reading a book about him and stuff, 10 times pre-tax profits was before. He was controlling the capital allocation stuff. Can you read me the second part of that?
Yeah, he says the market on one end seems very expensive, growth stocks while value is cheap. Thoughts? I think I said the market cap.
I don't know if value is that cheap, but I don't think it's expensive. So yeah, growth, I guess, would seem expensive to me, while value would seem like it offers a good possible returns for the future. I don't want to say that it's like some amazing opportunity to buy value. It's not, but it does seem like something that if you bought value stocks, you get the kinds of returns people expect from stocks. So if people are expecting more 10% type returns and not 5%, I definitely think that value, I guess, is what you would say is more the bucket that they should be in. So I don't think value is overpriced. But I've said that before too, like I'd have to look back, but
What are you looking for?
Siri just talked to us, or Alexa just talked to us.
Yeah.
We're good.
I would have to look back, but I think that in this bull market, really it's that growth has outperformed, not that value has underperformed.
Alexa is continuing to talk to us.
Yeah.
This is a good question. Do we need to rebase the multiples that are quoted in The Intelligent Investor, 1.5 times book, 15 times earnings, et cetera, to reflect today's near zero interest rate environment?
Most people would say yes. And Graham had a method for doing that. And by that method, for the overall Dow, a central tendency sort of thing that he calculated, central value, it would say that stocks are cheap because it would put in valuation. It would use corporate bond yield stuff. So like he would use 2 times the corporate bond yield as an estimate of what your earnings yield should be and things like that. But I personally believe no. I'm completely alone on this, but based on history and things like that, the problem is that if you put in current interest rates, then rises in interest rates will cause you large losses, exactly the same as you would with bonds, with very, very long-term bonds. So if you're saying, should I buy stocks because interest rates are low on a different valuation basis, absolutely, that you're justified in doing that. But the question you have to ask yourself is, are you happy holding a 100-year corporate bond or something like that? Because a stock is pretty similar to that. So if you're not happy with the interest rate risk on that, then I would think you shouldn't be happy with the valuation risk. So that, you're taking interest rate risk if you do that, and sometimes it's worked out and sometimes it hasn't. But I wouldn't want to take an interest rate bet.
Next question says Snap Judgment on CPRI was trading as low as $5 in March, which was basically a price to free cash flow ratio of 1. You could pull it up. You familiar with this company?
No, I don't. Well, we'll see.
Capri Holdings.
Oh, actually.
$2.2 billion company.
Yeah.
Designs, markets, distributes, and retails branded women's and men's apparel and accessories in the United States, Canada, Latin America, Europe, and the Middle East, Africa, and Asia. Let's see. Current price to earnings, 6.6 times. EBIT to sales, 0.5. 10-year median margins on EBIT, 18%. Looks like revenue's gone from $508 million in 2010 to $5.2 billion in 2019. EBIT to free cash flow 6.
Yeah, we're using QuickFS here.
We are using QuickFS, and if you want to sign up for QuickFS, tell them you came from Focus Compounding.
Yeah. So do you know what they sell so that I have any basis on which to give a judgment here?
Let's see.
We're just in an area here.
They sell Versace.
Okay.
It says as well as through Versace e-commerce sites in the United States, Europe, and China.
Right. So we're just in
Versace brand names.
Right. So I just don't know anything about high fashion stuff, so I just couldn't touch that.
You don't know anything about high fashion?
No. It's just something I can't judge. But I mean, obviously on the numbers, it looked cheap at the time you're talking about it, and it looks cheap now, certainly.
Yeah.
But
those median returns, return on equity, 41%.
Right. But it's kind of like if someone asked me about, I mean, maybe I could value LVMH or something that's a diversified set of things. But if someone said, well, what do you think about Guess versus whatever, or Coach and Michael Kors and stuff and whatever, we're getting into different categories of things. But I have no way on which to base their future, So some people might know a lot more about whether things are in or out of fashion that way.
Look at that disparity between net income to cash flow. 2018, $592 million in net income, and then cash flow from operations over $1 billion. In 2017, $552 million, cash flow $1 billion.
Okay. So yeah, I mean, we do
acquisitions.
use cash flow. That's what we focus on. So, I mean, on these numbers, these are good looking numbers, but it's just something that, I mean, I'm not, I'm not qualified to give an answer on that. It was like when Howard Marks was saying, I go to China and then people ask me, what do you think about China? I mean, you would know more about it. If you've looked at the stock and if you look in the industry and stuff, you just know more about it than I do. So I can look at the numbers, but that's kind of the easy part.
Exit strategy for stocks.
Exit strategy is, I don't know what that means exactly.
Well, you want to find a stock that you could hold for forever, essentially, right?
Sure. Although a stock that you can't hold forever that's cheap enough is fine too. So if it's going to give you very high returns that way, I'm fine with that too. So exit strategy for buying a net can be to sell, a year later if it's still, if it goes over net current asset value, checking in a year. But for better stocks, better quality companies and things is to own them for the long term. Sure. But if they lose their quality or whatever, then you sell them. Sure. I don't have price targets and things if anyone's asking, like that kind of thing. I never use those.
Next question. Can you recommend any books to learn about distressed debt investing?
No, I can't. There are some books about it, but I either didn't like them or haven't read them.
Next question. When looking at dividend stocks for people with limited disposable income, why shouldn't they buy Canadian companies that pay dividends? The U.S., it says CND means more buying power for shares.
Okay. I don't know. I just don't.
Saying the U.S. is greater than?
Right. I just don't know much of anything about Canada.
What is your process for generating new investment ideas?
I wish it was better. The process is not good. The process is looking around a lot, reading a lot of things. A lot of 10Ks that I know from the beginning are probably not going to turn into investment opportunities. Occasionally finding something that looks like it has one or two things wrong with it or something, but otherwise looks great. And then we kind of figure out, is this really wrong with it? What's the deal? I don't know. Maybe let's do some scuttlebutt. Let's get in depth with it, things like that. So it tends to be we find something that's like a business that I like for some reason, and then the price is low enough, and then there's something wrong with it. And in many cases, that something wrong is something I can't prove isn't wrong with it. But in the other cases, we actually find something that we can follow up on. So the main problem is like finding something to follow up on.
I would agree with that. But do you ever feel like when there's a good idea that comes across, you're like, you just know it kind of instantly? You're like, oh, this is very interesting.
Yeah. I kind of have a list of questions of what could be wrong with it, I guess. But it's something that as long as this isn't a deal breaker or whatever, I would buy. I mean, that's the unfortunate part. I've said that before. Like, it doesn't usually take a real long time to figure out something's a good business. It doesn't really take a long time usually to figure out it's cheap enough. Most stocks I look at, the problem is they're not cheap enough for us. So even if I know they're good business, and then the ones that are cheap enough, it's that they're not a good enough business of what we want. So it's that sweet spot. So yeah, the problem is, unfortunately, I wish once we know a little bit about a stock, our process is pretty good. It's finding the next stock to research in depth. I wish we had this big backlog of stocks that we just want to research in depth. We want to meet their management and go visit and study them for 100 hours and stuff like that. And we don't. We have a lot of companies that we look at in a matter of a few hours, I can tell, aren't in that class for us. So it's the biggest investment problem we have, and it kind of always been my biggest investment problem. It's particularly bad now, but it's always been a big problem.
Next question. What do you think about Arbistar?
I don't think I know that.
Here you go. If you like Tandy Leather as a business, while also being a potential net, what does hold you back to make it part of your portfolio? Do you want to see the delisting from NASDAQ?
No, I mean, it's funny. People always believe that delisting will cause the stock to drop a lot. I'd be careful about that. It's happened to people. I think that a stock has been delisted or whatever, and then they've waited for it to keep dropping and it hasn't. So I wouldn't necessarily say that is what will happen. I've seen some companies I liked. It wouldn't bother me one way or the other that way. For NetNet and stuff, you would need to see their latest balance sheet. They're not talking to publicly and stuff really until they do that. I think there's no way they could wait longer than August for that. I'm not up to date on when regulatorily they'd have to do that. So they expect sometime this summer to come out with it, and I would just expect that you would wait till then. That's not it, though. I mean, I'll be honest. It's to hear from management and stuff, because I continue to have two concerns, which were the concerns when I first did research on them like 5 years ago or something. What are they doing with their big customers? They're like wholesale type customers. What are those relationships like? And what are they doing on the store manager front? Now, they did talk about closing stores and stuff. So if they're closing down stores, that could mean the store managers left are better. It could mean that they're going to change compensation for store managers, whatever. But those are always been my two questions. So it's really, I want the silence period that they've been having since not filing 10Ks to end. So we get a really good feel for the CEO, maybe for the board, for whatever, but what they're doing, what they're planning as a turnaround. And they just haven't had that communication from management. There's not really much they can say when they're not filing with the SEC. But they're supposed to be, so they're just not going to talk to people in ways that are going to be helpful that way. But it actually has nothing to do with that. It's just mainly those two concerns, like the scuttlebutt type concerns I've always had, which is what are they doing to keep their biggest customers happy and stuff like that, and what are they doing on the store manager front to make sure that every store that they have is profitable, efficient, and run by the right person.
What are your thoughts on risks to over-the-counter markets from SEC regulatory changes?
Yeah, it's a risk. I don't know the answer to that. People have brought it up. I mean, OTC markets has had comments on it. Lots of other people have had comments on it. I've heard people talking about it a lot. What it would mean is basically, in the worst case scenario and stuff of it, is that dark stocks basically would not be able to be quoted by brokers. So it would become basically a by appointment type market, or whatever you want to call it exactly. I don't know how much effect it has specifically on the stocks that we look at. Our stocks are generally current. We have some things that I guess wouldn't be current that way. Also, for us in a fund and stuff, I don't know how much we care, and it could create opportunities to buy things. We don't need to have a broker quote on things it doesn't matter to us. And if that scares everyone else out of the market, then I guess some things will be incredibly cheap. Managed accounts, I don't know. It could be a little bit more complicated.
Profile pic from a frat composite. No, I was not in a fraternity. I do not like beer. All right. And then we got let's see. We got one more. Snap Judgment. CPL Resources.
Okay.
Market cap 220 million. They provide staffing, recruitment, training, and outsourcing services in Ireland and the United Kingdom and internationally.
This is an industry I feel I don't know that well ever.
You come across a lot of these. They're usually pretty cheap.
Yeah, so there's attractive things about it. And there's a book about NetNets that talked about this. What was the name of it? I don't remember. I don't have it on my bookshelf here. But that talked about NetNets and liking in particular service type companies and things like that. What's attractive about these companies often is that they're kind of cheap and they don't have a lot of capital, or what capital they do have is kind of current assets and stuff. Yeah, like the services in that way. But they're cyclical enough that they sometimes get mispriced. The problem with a lot of service stocks for us is if they're successful, they're not cyclical enough to actually cause them to get crazy cheap or anything. So let's look at some of the valuation and stuff.
Mm-hmm. So we got a current PE of 9 times, EV to free cash flow 7.5 times, EV to sales 0.3, 10-year median margins of EBIT is 3.5. I'm kind of surprised it's not. I guess I don't know. 10-year CAGR on revenue 8%, going from 232 million in 2010 to 638 million in 2019. 10-year median returns, return on equity 15%, return on invested capital about 29%. But the 10-year CAGR on EPS has been 43%.
So I don't know. Obviously, because of the way those 10 years fall and stuff, that's like a recovery.
It's a great 10 years. But I mean, this is also in Ireland and the United Kingdom.
Right. Yeah. I mean, in terms of the momentum, it's great. In terms of the actual levels, maybe not, but obviously you started at a bad point at the beginning and ended at a good point. From the median on operating margin and the EV to sales now, looks perfectly good. And it just seems like it could be trading for like 2/3 or less of what the kind of overall market is trading for, and doesn't have things that are obviously wrong with it from a snap judgment perspective. Not in the country that I live in, and definitely not in an area I know a lot about, staffing stuff. So those are two issues. But if you know those things, and if it's a company you're comfortable with, certainly the price seems reasonable to the extent of at least trading at least I'd say 30 or 40% or more cheaper than much of the market tends to now. I mean, 30 to 50% cheaper, it really does seem like, based on earning power and stuff. So yeah, it looks cheap if you know the business and like the business. Yeah.
Cool. Well, that is the last question. And look at that, 25 minutes, 18 seconds. So we did a good job. I want to thank everybody so much for tuning in with Geoff and myself. We did use QuickFS. And like I did say, if you want to sign up for QuickFS at quickfs.net, make sure you tell them that you came from Focused Compounding. I want to thank everybody so much for tuning in with Geoff and myself. Subscribe to us on YouTube. It goes a very long way. And then, of course, if you subscribe on the podcast side of things, that also goes a long way for us as well. I want to thank everybody so much for tuning in, and we will see you in the next podcast.